Oh, well, thank you, Marty. And that's obviously going to be a big discussion point over the next couple of days, not just on this panel. But it's excited to get the panel discussion started here for the New York session in February. This is fantastic. Marty's already said we're doing emerging managers, and we've got three really interesting people. I think you're going to want to hear their stories, their backgrounds, and why they think they can make money in this environment. We have Michael Coolbaugh, who is the founder and CIO of Strom Capital Management, discretionary global macro strategy. We have Michael Friedlander, whose camera is now on, so you could see him. He is the Chief Operating Officer and the Chief Risk Officer for Infini Capital Management, a multi-strategy investment approach across global markets and a variety of asset classes too. So he's going to be a very interesting person to talk to about what he sees and where he's placing his bets, given this. And then we have Mina Tadrus, who's with Tadrus Capital, and he does high frequency trading. So he's going to be a very interesting person too, to hear what his current thinking is, how he plans to change and adjust as things go on. And just so you know, in the audience in New York is Chip Perkins. And Chip's on the next panel technically, but I got a feeling we'll be hearing from Chip during this panel too. Chip is a placement agent who has placed, what is it, 8 billion, Chip, over the last 20 years? Or is he getting a cup of coffee right now?
He's in the room at the moment.
I think so.
Fair enough. Anyway, it's always great to hear from Chip. And Marty will also be chiming in with questions from time to time. My name is Mark Heil. I'm with Pacific Premier Trust. We do a lot of investing. We help investors make investments into alternatives using the retirement dollars. The major advantage of the retirement dollars is that if you invest through a self-directed IRA, you don't pay tax on that when you withdraw your monies out of it. So if your investments increase 3-4 times, you're the beneficiary of all that money. We also custody funds. So if you have a hedge fund or private equity funding, you need that custody. We handle that as well as some other services. But we are part of Pacific Premier Bank, and this is a lot of people's favorite part of the whole morning. I have to read our disclaimer. So for me to moderate these sessions. So let me knock that out and make my lawyers very happy. Pacific Premier Trust performs the duties of an independent custodian of assets for self-directed individual and business retirement accounts and does not provide investment advice, sell investments, or offer any tax or legal advice. Clients or potential clients are advised to perform their own due diligence in choosing any investment opportunity, as well as selecting a professional to assist them with that investment opportunity. Alternative investments, as we all know, are not FDIC insured and are subject to loss, including the loss of principal. Pacific Premier Trust is not affiliated with any financial professional, investment sponsor, or tax or legal advisor. So there's our disclaimer. It's out of the way. We don't have to do that anymore. Those of you who've seen me do panels before for Marty, you know what I really enjoy is when the audience gets involved. So don't sit on your hands. Feel free to raise them or get Marty's attention. He'll get you on camera. If you want to be on camera, you can just ask it from the back of the room. And feel free to chime in, because the more interactive it is, the better it is for everybody. But I would ask you, if you're going to ask a question, don't make it a speech. Get to your point, be concise, so that everybody on the panel has the time to respond to it and to keep this program moving. Already gave a high level of introductions of our panel this morning. What I'd like to do right now is just give them a chance to speak and introduce themselves. So I'm going to start with Mike Coolbaugh. Mike is founder, CIO of Strom Capital Management, a discretionary global strategy. So Mike, give a little more background, give a little color to the play-by-play there.
All right. Thank you, Mark. Yeah, so as Mark mentioned, I'm the founder of Strom Capital Management, and our specialty is in discretionary global macro. I founded Strom in March of last year to manage a few separately managed accounts in order to build a track record. And the goal with that track record is essentially launch a flagship fund early this year. But as it pertains to our approach, in a nutshell, we're looking for opportunistic long convexity trades. What is long convexity? It's essentially a bet on the fatter tails. You can think of the inverse, short convexity, and that's, almost every other strategy out there, whether it's mean reversion, value, fixed income. Those are all short convexity in that it's a bet on a return to normalcy, assuming some sort of a normal distribution. Long short equity betting on, differentials and valuations. So we're a diversifier in that we're betting on those larger tails. And just for reference, if you look at 2022 so far, we've already seen, I think it's either 5 or 6 events that have registered as 3 sigma or greater events, which certainly shouldn't be happening more than once a year, but 5-6 times in the first 2 months, just goes to show sort of the unprecedented environment that we are in. And so, the way we go about the world is we look at everything through what we call our 4-pillar analysis. And those 4 pillars are liquidity, valuation, sentiment, and technicals. The easiest way to break these down are, we have 2 longer term structural drivers, which is liquidity and valuation. And then we use sentiment and technicals for sort of your shorter term, more tactical decision-making process. So, once we've identified the trades or opportunities that we believe have the greatest potential, we then use a host of internal, what we call acceleration models, because, from my experience, moments of acceleration in the market are often a sign of shifting sentiment. And so ideally what we're looking for is a contrarian trade where market behavior is not confirming that consensus view. And we're looking for those sort of market signals to a potential unwind that can lead to powerful moves. And then just a quick background on myself. Before I branched off on my own, I spent the last 9 years at various hedge funds. And the latest stop before my own firm here is I was at K2 Advisors, which is a hedge fund to fund subsidiary at Franklin Templeton. And there I helped to run direct trading strategies and assisted with the firm's conditional overlay program. So, as a result of the feedback from my, macro analysis that I was doing as part of the risk overlay program, I did decide to launch my own independent research firm back in July of 2019. And since then, I've been publishing macro research to high net worth individuals and institutions. And where Strom kind of came out of all of that was I had a handful of clients approach me at the end of 2020, kind of scared by the volatility, and asked, we love your research, but we can't put the trades on ourselves. We're just too scared. So would you manage money on our behalf? And so that's really where Strom kind of came out of, was sort of the tail end of 2020 and clients of my research directly.
Fantastic. Michael Friedlander. Now we have Michael Coolbaugh and Michael Friedlander. So I'm going to call Michael Coolbaugh Mike, and then I'll call Michael Friedlander Michael. So we'll try to keep it straight that way. But Michael, why don't you tell us a little bit about yourself and a little bit about your firm?
I'll do that, Mark, and thank you very much. And that works, by the way, because when I'm in trouble, my wife calls me Mike. So when I'm not, it's Michael. So that works well. So thanks for the opportunity to join everybody this morning. I'm the COO, Chief Risk Officer for Infini Capital Management. Infini launched in June of 2019. We, as Mark introduced us, we are a multi-manager, multi-asset hedge fund, principally domiciled in Hong Kong. Though over the last 3 years, we actually now have trading operations, again, principally in Hong Kong, but in the PRC in Taiwan and the United States. So we currently have 14 hedge fund teams scattered across those markets. We are truly a global we run multiple strategies, vanilla equity long shorts, specific equity long shorts, ARB strategies, index ARB, crypto strategies. We run tactical macro trading strategies, tactical equity, global equity trading strategies. And so we're relatively strategy agnostic, relatively market agnostic, where there's an opportunity that presents itself, then we're happy to work with the manager and allocate some risk capital to them and let them rock and roll. We launched in June of 2019 with three portfolio managers and $40 million. Today we've got around $300 million. And as I mentioned, 14 portfolio managers globally. Cumulative performance over the 3 years, call it 3 years of operation now, is roughly 400%. We like to think that we are a true absolute return strategy. If you look at our return series and do the regression analysis against, global equities, global fixed income, vol, credit spreads, all the classic factors that institutional investors are exposed to, the betas against all those factors are statistically insignificant. So, again, we like to think that we're a classic, a very classic absolute return fund. In terms of my background, originally started in the business in private equity, and I did private equity for a number of years globally, but principally in Latin America. Then went to go run risk for APG Asset Management, pension fund based in New York. In 2006, they asked me to move to Hong Kong to open up the office in Hong Kong. Worked for them for a number of years, building out the Hong Kong office. From there, went to Millennium. And I was at IT in Asia for Millennium for a number of years, then did a number of startups, and here we are today.
Yeah, you came through pretty good until the very end when you were talking about Millennium there. Could you just repeat what you said about your role at Millennium?
Yeah, sure. So when I was at Millennium, I was based in Hong Kong, and I was the regional head of risk, regional head of operations, regional head of IT, and I handled all the onboarding for all of our portfolio managers.
Fantastic. Thank you. Mina, why don't you chime in here and tell us a little bit about Tadrus Capital and the high frequency trading that you do and how this works for investors. So.
Sure. So by way of introduction, I'm the founder and CEO of Tadrus Capital. Marty and Mark, thanks for having me here. So we essentially identified 7 things that have led to the creation of Tadrus Capital, and that's based on my previous experience. I started trading in law school, and then worked for JP Morgan as a derivative consultant, and then C3 as a trader for them, and then a trading desk supervisor. And I didn't really see that I had anything proprietary until one day just hit me, and I thought that it was worth going off on my own. And so these 7 points are essentially bad or no use of proper algos. In the US, most algos are used for market making or position sizing, where trades are typically discretionary. 2, the wrong forecast horizon by most hedge fund managers and asset managers. Everyone's trying to forecast something a year out, 2 years out, where to me, that's irrelevant. I'm more interested in what's happening tomorrow, what's happening this week. And so there's a beautiful, actually, Netflix documentary that discusses forecasting as far as how one forecasts the weather, right? So if you're forecasting tomorrow, you have a very high degree of accuracy. Tuesday, that accuracy goes down. Wednesday, that goes down. On the 4th or 5th day, there's virtually no accuracy. And so we have that same exact perspective on trading and investing. Bad risk management. There are 2 main components of that. One, improper asset diversification. Most hedge funds in the US, as you know, are long only US equities, right? So case in point, ARK, right? Ridiculous drawdown, which leads us to why? Because all the assets are correlated. Which leads us to our second point, no stop loss. No, second point within risk management, no stop losses. That ridiculous drawdown, with all due respect, is frankly ridiculous for investors. So every order that we place has to have a stop loss. It's a company policy, and for some of our investors, it's an investor policy. And depending on the algo that we're using at the time, it may or may not have a take profit. 4, the 4th point that we've observed, and in part this was created because of COVID, Investors no longer want to wait 1 year before they start reaping and recouping their investment. So we created a fixed income product. And I'll explain why, perhaps later on, why we did that, but with the use of leverage, which is our fifth point. Leverage is typically frowned upon in the US, in part because of regulations, portfolio fee margin, but overseas you can get massive amounts of leverage. And it doesn't really make sense to us why it's frowned upon. Everyone uses a credit card. Why not use a credit card to increase your business revenue? And so that's our perspective. That's exactly what we do and why we do it. The sixth point is trading frequency. The longer the trade duration, the less profit that we can make because we're not taking advantage of the volatility. So the more frequency, the more trades we have, the higher the frequency, the more money we can make essentially. And of course, last point, taxes, right? Nobody wants to pay taxes. Imagine we could explore synergy with a local city to create a municipal bond that's tax exempt. And that's the seventh point. We've basically virtually resolved, the first 6 points, and we're currently working on this seventh point. We're working with a local city here out of Florida that will allow us to create a government bond, and we're going to manage that bond, and hopefully it'll be tax exempt pending IRS approval.
Fantastic. Tell us just a little bit about your background, your personal background, what you did before starting Tadrus.
Yeah, so first semester of law school, I have a bachelor's in international global studies. I was in the Navy Reserves, and then I got my master's in intelligence studies. Then I went to law school, and first semester of law school is when I really got into trading and really learned how to code myself and figured out how to properly quantify risk and quantify the volatile movement of an asset. Then I joined JP Morgan on their derivatives team in the financial district in New York City. Then Q3, just a few blocks away, was a trader for them, then became a trading desk supervisor, and then decided to go on my own. So we're a small team of 8 at the moment, but our trade operations are essentially out of London, Sweden, and the Czech Republic.
Fantastic. And yes, we will dive into all that. So you're going to get to a lot more during this conversation. Sort of kick this off, Michael, I'm going to start with you. You mentioned that you grew from 40 million to 300 million when you're giving a little discussion over the last 2 or 3 years. I'd like to get a sense as to what attracted investors towards you. What was really the driving factor that made them want to put their money with what you were doing? So give a little background here if you could.
Sure, Mark, thanks. So when Tony and I first launched the fund, we wanted to build a lot of our systems and processes on proven principles. Given my background in Millennium, there's quite a bit of Millennium DNA built into the way we do business. From a risk management standpoint, from a process standpoint, things like that. But obviously, just given the size, that would have been, a suicide mission to try to, compete with the likes of Millennium, with this point, or one of our. So we had to figure out or establish what would be our competitive advantage, or what was going to be different about it. So one of the principal points that's different about it, or what has driven our returns, has been so rather than going after the very large portfolio managers, guys who can on day one play $100 million, $500 million over the course of 18 months. We go to the other end of the spectrum. So, our typical portfolio manager is somebody who maybe on one play $5 or $10 million, and then maybe they're scalable to 30 or 40 or maybe $50 million. So the talent that we recruit, they tend to be very specialized, they tend to be very niche, and more importantly, they tend to be capacity constrained as much as anything. And the capacity constraints can come about simply based on the product or the assets that they're trading, or it could be because of the risk limits that we impose upon them, that there's certain capacity constraints. And so classically, these portfolio managers would have been a sub PM or maybe they tried launching their own fund, but couldn't on their own, where they want to come and work on our platform, where they have the backing of an institution like Infini Capital Management, but they're able to trade what it is that they do best. And so we have enjoyed a explosive growth of finding of talent, and it's people that have a proven track record and people that have access and are doing strategies where these kind of strategies exist in the bigger funds, but they tend to be such a small relative proportion of the overall return series and the AUM, it gets completely washed out in the returns of a Millennium or Nexus Point or Point 22. Whereas for us, that return series is the principal return series that investors are looking at. And so, I would like to think that investors have been satisfied with our returns. They recognize the nature of what it is that we do. They appreciate the risk management and the institutional infrastructure that we've put in place. And as well, having been an allocator myself when I was at APG, I think I'd like to think that I have a bit of a sense of what's important to an institutional investor. And so when we built our systems and processes, when people come in and do an operational due diligence, it's very rare that we come out with any red flags. Always there's places to improve, and we're always very keen to capture those improvements. But I like to think that from an institutional standpoint, we're very robust. From an investment return series, we're an excellent absolute return strategy, and we're finally providing something that's perhaps a bit unique compared to what they may be able to get somewhere else, which all in total makes it an interesting investment strategy.
So as this growth from 40 million to 30 million, or 300 million rather, obviously 30 million be the wrong direction,
Right.
but 40 to 300 million, has that been primarily institutional money coming in, or has that been primarily ultra high net worth money or family office? Give us a little flavor for who your investor base is.
It's actually been principally P&L that we've generated over the course of the 3 years.
Interesting.
Our cornerstone investor remains my partner and the founder, Tony Finn. The bulk of the assets are his. However, we have attracted basically three other material investors. One is the private wealth management form of a big U.S. bank, and we have attracted the family offices of 2 large U.S. family offices.
And your future growth now, people who you're talking to a family office network here.
Yes.
But is that who you're seeing as your future, or you're going for, are you, where do you see your future investors coming from? And is there a capacity size, is there something you don't want to exceed in size?
Yeah, it's let me answer the second question first, and then I'll come back. So, with a firm that's our size running, a platform, there's always this chicken and egg question. So do we go raise money and then go try to find talent, or do we find talent and then try to go raise money? And so balancing the growth of AUM with our ability to deploy it, that's always the challenge. I'm very happy that where we sit today is with the talent that we have on board and the strategies that are being run, we could easily double the allocation of the portfolio managers that we currently have on board today, tomorrow morning, and not miss a beat. So we actually have a fair amount of capacity, and then of course that then would draw other talent towards it. So I think we're in an excellent position in terms of being able to deploy capital and put it to use. In terms of who we're targeting, one of the things over my career, I've had the role of raising capital for the last 10 years in the different roles that I've had in startup hedge funds. And what I have found is there was an old my gray hair will give it away. There was an old commercial years ago, Ernest and Julio Gallo, where they said no shall be served before its time. I've kind of come to learn that in the hedge fund industry, and that is no allocations will come before their time. And so I'm a little bit less stressed about, of course we need to be in the market, of course we need to be talking to people, Of course, we need to be giving our pitch at conferences like this and cap intro meetings and things like that. But we're well above our break-even point. The principal investor is very happy where they're at. And look, we'd love to be $1 billion fund. We're not going to start. When the money gets there, and we'll continue to engage with the allocation community, and yeah, it'll happen when it happens.
Fair enough. Thank you. I'm going to turn this over to Mike now. Mike, you're obviously in a different spot. You're just launching your fund right now. Talk to us a little bit about, why the ultra high net worth individuals and the family offices should be interested in your strategy. So take it away.
Yeah. So to set the stage, I just want to, there's a concept that, I don't know if someone else has come up with it, but it's what I call the institutionalization of hedge funds. It's something that I became intimately familiar with while I was at K2 Advisors. And in essence, it's the idea that this major influx of institutional capital, state plans, pension funds, large fund of funds, such as, the likes of Blackstone, they've created an incentive structure that leads most hedge funds to underperform. They're essentially overpriced mutual funds. And that's just simply because the goal is to tightly hug a benchmark with just lower volatility for most hedge funds. Why? Because that's what creates stability, leads to asset growth, and then revenue growth. If you think about it from the really large allocators, there's career risk. You have to report to your board of directors. So do you want to go with a smaller manager who is putting up better returns, but there's a little uncertainty there? Or go to the $10 billion shop where, if they suddenly blow up, well, everyone on the street is blowing up. So, it's similar to the whole FANG craze in the marketplace where, what portfolio manager is going to get fired for being an Apple? For me, I look at it as there's not always a lot of the institutions are essentially looking for low net exposure and low volatility. And the belief there is that low net exposure, low volatility means low risk. And what a lot of these funds are doing is they're essentially hiding leveraged factor exposures behind this moniker of low net exposure. You can think of being long Amazon and PayPal as sort of an e-commerce play, and then short the brick and mortar retailers. On paper, it looks like a low net, low volatility strategy. But in reality, it's just one levered play on a larger theme. So, the question is, how are we different, and why should allocators, look towards us as we look to launch our first fund? Is, on one hand, being smaller means we can be much more nimbler than the larger players. A 5, 10, 20% position isn't going to move the market. This liquidity of positions is something we've seen in the news a lot lately. You look at the likes of Melvin Capital, D1, Tiger Global. A lot of these guys got caught in the meme craze. And it's even played out in the global macro space for a lot of the larger 10, $20 billion funds, that got caught in certain rate positions or yield curve plays just recently. Second, we take directional bets. And, I know that can be scary for some people. Institutions in particular don't like directional. But in essence, we're not trying to hide behind the low net factor risk. If we have a view, we're going to express that view and accept the risk, but we're going to control that risk. Oftentimes hedging can lead to adding to your risk as opposed to mitigating it. And this is something that I was intimately familiar with on the risk overlay team at K2 Advisors. And so, we look at each view, we look at each theme, and we allocate a certain percent of risk. And, if we become unsure about that view or decide that we're wrong, we either eliminate it entirely or reduce the size of the position, as opposed to adding a potential hedge that could backfire, like you're seeing with a lot of the short squeezes recently. The third point is we are an absolute return vehicle. So, we're not interested in benchmarking, whether stocks are up or down, bonds are up and down, commodities are up and down. Our goal is to generate strong, absolute positive returns in any environment. And that's actually what's really exciting, listening to Joseph speak earlier, is that, if you think back to the golden days of the discretionary macro guys like Paul Tudor Jones and Louis Bacon, a lot of them cut their teeth in the 70s when you had some of these similar, circumstances playing out, and there's so much uncertainty, and there had to be this, sort of discretionary, price action trader behind a lot of these guys. And so, that's really what we're aiming for, is if we're heading for something like Joseph is talking about, where stocks could underperform, even negative, bonds underperform or negative. Being an absolute return is, we hope to be, there as rock solid and continue to perform as a diversifier in your traditional asset allocation. Fourth is we have implemented, when we launch, is an improved fee structure. So what we call, it's an OR structure. And Texas Teachers Retirement System actually came out with a white paper on this. And what it does is essentially the manager trades in his earned management fee in exchange for a percentage of the alpha that he's generated. It's different from the and structure, if you think of 2 and 20, where, investors get sort of double penalized. They have the management fee taken away, and then they're also paying the performance fee. Whereas, once you pay you're paying your management fee, and then once the performance fee is calculated, you're deducting away what you already paid. So you're not sort of, taking that double hit. And then fifth, we do really view our clients as partners, and this is something we've done with the SMA structure for the track record, is all of our research from my firm, independent research firm, Element Macro Research. All clients of Strom from the asset management side are provided free access to this research. So, one is we're hopeful that we provide additional insights for your other asset allocations outside of us. But also it's just an increased level of transparency, where the client is kind of on a daily basis updated as to what we're thinking, what we're looking at around the world, how we might be repositioning the portfolio. So just that, added level of transparency. And then lastly, as it pertains to, as you're talking about, the family offices and ultra high net worth individuals, I talked about the institutions having a different incentive structure where, there may be a little bit of volatility in this strategy, but again, our goal is those absolute returns. And so we're looking for partners that, that's what they want at the end of the day, is those strong absolute returns, and not necessarily get scared away by a little bit of volatility. Again, I like to reference the traditional global macro funds of the years past. A lot of them have closed down. And so as we're going on our, speaking to potential seed partners, that is something that's attractive to family offices or high net worth individuals is, as part of these seed deals, when we look to launch in the second quarter this year, we are open to enhanced economics that will, add to just the total fund return. So, think of something like a revenue share, where the seed investor might get, X% return on the fund, but then also a cut of the revenue share as well, as an enhanced benefit to being early in the fund.
So have you had conversations with potential seeders for your fund?
Yeah, so we've had a few preliminary conversations. I've been sending around monthly updates, keeping the different allocators that I've spoken with updated on the progress of our track record. So, as of the end of January, we're just, March will be essentially one full year of track record. And so, every month they send around a one-page update that includes sort of a brief commentary in terms of what drove our performance, and updated the performance and just different benchmark comparisons. So, having those conversations sort of ongoing right now.
Yeah. So in terms of, what they're looking at, and they're thinking about how to structure a deal, what are the things or terms or items that are of most interest to those seeders when you talk to them?
Well, I would say for the most part, the conversations thus far have been those enhanced economics. Performance for the fund has been strong. As we close it out a year, I think it's close to 20% return since March of last year, and with that has been a very low correlation. And so that isn't a very attractive thing that these seeders are looking at. Is we have I would say it's sub 0.2 correlations to all your traditional benchmarks, bonds. It's a zero correlation to equities. 0.06 correlation to the broader macro index, global macro index. And so we have a very low correlation as a strong diversifier. So that is one aspect that's really attractive. Obviously, the returns help. But then the enhanced economics, there's been several white papers written about, how emerging managers do tend to outperform the larger, more established, whether that's, enhanced economics or just, the earlier managers tend to be hungrier as they're trying to grow and establish their business, nimbler, being able to move in and out of positions without impacting the market. So.
And are they offering some services for that enhanced economics?
So there have been some that will be, they'll be full fee paying, and then in return they get the enhanced economics because, the view is that.
No, I meant services they provide to you. So do they provide back office services? Do they give you an office space? Things like that to help make you be successful. I mean, oftentimes that's things that Cedars offer. So I was curious if you've been getting those types of offers.
So that's where there's two different paths there. One is the group that's, offering to pay a full fee structure. And with that, the increased free fee revenue will help to pay for, my own sourcing of back office or operations. Or there's the other hand where there's a slightly reduced potential fee structure with the assistance of capital raising or back office or things of that nature.
Fantastic. Thank you. Mina, I want to toss the same question out to you. Who are your investors and who are you trying to attract?
From my experience, most investors who truly understand high frequency trading tend to be institutional investors, especially overseas guys where leverage is commonly used, algorithms are commonly used, 4 to 10% monthly return is expected with the use of leverage. That tends to attract institutional guys overseas, whereas in the US, this is a very new product that's relatively unheard of. So to get to the point, as far as why should investors invest? Well, it's very simple. If you can find a US-based investor that will give an investor more than 4% a month, then you should obviously go with them. If not, then we're happy to do business. So it's very, very straightforward for us.
Talk to us about that 4% a month. I know you sort of referenced it when you introduced yourself, but go a little bit deeper into how you generate that and how people get that back and how it's been going so far.
Yeah, so traditionally, hedge fund managers use very little to no leverage at all, right? And that's reflected in the return. And so imagine you have a business. Why wouldn't you want to use credit to amplify your return? So that's exactly what our perspective is. So with the help of the brokers that we've partnered with, we can easily get a lot of leverage. And we use up to 400 times leverage. It doesn't mean that we use it all. It doesn't mean that we're risking all the money that we're trading with. That's simply the position size. What we're risking is the price difference between the purchase price and the stop loss. That's what we're risking. So we can move, per position 200K and risk only $100. So it's not as crazy as or as scary as investors may hear once they hear of leverage. It's extremely scary if there's no stop loss, sure, because then we can easily go bankrupt, right? But with stop loss, and that's automated, the second order is placed in. I would argue it's safer than not having a stop loss. That would be my strong argument.
Terrific. Thank you. Michael Friedlander, I want to toss this one out to you. And one of the reasons why I want to toss it out to you is because we hear a lot from, family offices and people, wealth managers and other types of investors. And one of the comments themes that I hear is, gee, he's really he was a great analyst. I love reading his research, but when he took the seat and we put money with him, it was a bad bet.
Yeah.
So how do you protect against that when you're making your manager selections?
It's a real issue, right? And if you don't manage it, it can be a bit of a crapshoot. So when we begin the conversation with a potential portfolio manager, there's really two principal elements that go into that. Number one is, do they have a track record, right? And I'm not talking about, as you suggested, which is often the case. Yeah, I was the healthcare analyst on a bigger fund. The issue is, did you have a book, the person taking risk, and were you the one awake at night wondering how the book was doing during Asian trading hours, right? So that's probably the first and probably one of the more important discussions. The second point, and this is again, it's a very important and a fundamental element of our risk management strategy, because while I would say 90% of the time, the only people we hire are people with track records, the reality of it is that people who come to us all the time that have very interesting investment strategies, but they may or may not be untested, or they have a core strategy, but they would like to do other things that are related or allied with it. And so the way we do that is it doesn't matter who you are, it doesn't matter where you came from, and it doesn't matter how you do business. The reality of it is that on day one, you will not be allocated more than the minimum amount of capital. And then what we do is we develop a model, or basically you tell me, what your risk profile is, we'll accept that risk profile within our risk framework or not. You tell me what return series I should expect for that. And then we actually develop a stochastic model that says over the next 30, 60, 90 days, given this set of market conditions, this is the family of return curves and risk curves we should expect to see from you. So at the end of 30 days, we sit down, okay, how did you do against this family of curves? If they've made money and they've done it within our risk parameters, we might allocate them a little more capital. Another 30 days, so 60 days, same thing. Another 30 days, 90 days, same thing. If after the end of 90 days, a portfolio manager either hasn't done what he said he was going to do, he couldn't live within our risk framework, and outside of external factors, market conditions or things like that, if they basically haven't demonstrated that they can actually generate P&L, they can't be on the platform anymore. It's really that simple. So by managing our exposure to an untested or an untried strategy on day one, closely and very carefully monitoring what's going on, it allows us to be able to actually take advantage of maybe some new things that may or may not even be able to be considered in the marketplace, and yet dramatically manage the downside risk. So those are the two ways that we handle the situation where new portfolio managers are onboarded and perhaps untested or untried trading strategies came on. Classic example of that was when we onboarded our first crypto trading team back in late 2019, early 2020. There wasn't a lot of institutional digital trading activity that had been done up to that point. Yeah, people have been trading their own book and people have been doing some interesting things, but at an institutional grade level, there wasn't a lot. We did that, it served us well, and crypto is now something out of our investment strategy.
Hey, Mike, you're on the flip side of this, I guess, to a certain extent. Why don't you take when they start drilling down on your portfolio manager skills and things of that, how do you answer those questions, and what are you trying to emphasize with your investors?
Yeah, so for my seat, what Michael's talking about is actually very familiar, because before I was at K2 Advisors helping to run the direct trading strategies, I was running partner capital with my own portfolio at a family office in New York City. And they had a very similar structure where you start off with the minimum amount of capital. After a month, see how you do, how do you progress, sit down with a risk manager. And so from a very early point in my career, really it was my second seat on the buy side, if you will, was a chance to run a pool of capital. I learned very quickly the risk management side, and then obviously going to K2 and helping the direct trading strategies, which were global, as well as risk overlay program, that's reinforced even more. So, from my perspective, I like to touch on two different ways that we really try to control risk. As I talked about, we look for moments of acceleration, and the question is, how do you avoid things like the meme craze, getting caught on the wrong end of that, or how do you avoid, if you participate in an accelerating move, long or short, that'll quickly reverse and you kind of get caught out on it. That's addressed in two different ways. First is we have daily risk models that are updated, intraday at the end of the day, and it monitors our exposures to individual securities and themes. So each trade that we enter has a predetermined stop loss, and this is adjusted for volatility, and it's bucketed under a certain theme. Each security by itself has a maximum risk limit according to where our stop is placed, and each theme, in aggregate, when you add it all up, has a maximum risk limit as well. And so, to me, and again, from my history, at different places, I don't want to rely on historical simulations like VAR or Monte Carlo simulations. I don't want to rely on correlations or factor exposures. The reason I size everything and how it may impact the total portfolio is because I want to know that if all correlations go to crap, which they do more often than not, I want to know what my maximum portfolio impact will be should every single stop loss be hit simultaneously. So if all of a sudden everything just goes awry and I have to just bail on everything, I want to know, okay, am I looking at a 5% drawdown? Am I looking at a 10% drawdown? Am I comfortable with that given the current environment? And so that's one way, is through our daily risk models. The other thing is it comes again from our 4-pillar analysis. And so if you remember, I talked about the shorter term buckets, sentiment and technicals, and we're constantly looking at those and how it relates to both potential trades and our position as it relates to, say, daily volume. So, the goal is to avoid the overly crowded trades, because the last thing you want to do is be fighting against the market as you're scrambling for the exits. Obviously, one of the recent trades that we can look at is the meme craze, where a lot of guys were caught short with 5, 6, 7, 10, 15 days to cover based off of volume. That's just the situation that we avoid. One way is we avoid names that have high short interest if we're on the short side, but we also rarely short individual equities. Short bets are primarily placed.
Ideally, we raise. Yes, I don't. I said this.
Hey,
I don't want to raise more.
Hold on a second. Gib, can you mute yourself, please?
We can definitely raise equity. That takes longer. That's not going to happen by Friday.
How do I mute this guy?
We have a couple expenses. I always want to take care of my priorities. I want to take care of interest payments because that makes.
There you go.
Thank you, Marty.
So we stay away from shorting individual equities for the most part. If we do, we monitor obviously short interest and what the conditions are if we need to cover that position. The same thing can be said for the long side. We always are monitoring how the rest of the market, speculators, how they're positioned, because if you're looking at a crowded trade, chances are that an accelerating move could quickly reverse, are greater. And so, in that instance, we might allocate less risk to that idea or avoid it altogether. One of the recent examples is, we were short Euro-dollar futures late last year in our strategy. And that would have worked spectacularly in January of this year as Fed rate hikes got priced in more aggressively. But it's something that we had basically bailed on, because we felt uncomfortable with how crowded the short position was in that trade. On the flip side, one that we felt was the better risk reward based off of market positioning was the curve flattener going back to late last year. And that's something where a lot of global macro funds were caught being in curve steepener positions, long twos, short tens. And we took the flip side of that, where, that was a potential situation where market positioning gives you that added boost to unwind as market pricing and market behavior was not confirming their thesis.
Great. Hey, Mina, I want to toss this out to you. Marty just posted it up here, and I think it fits in. But what is the impact of energy, supply chain, inflation, interest rate hikes, and on your strategies and your high frequency trading? How does that impact there? Have you placed bets in reaction to these, or are you more systematic in terms of how you do your high frequency trading?
So it actually doesn't affect us in any way whatsoever. If anything, I want to say maybe we might end up making a little bit more profit because of it, because as you know, things go down quicker than they go up, right? So because we have the ability to short, it's equally beneficial, if not more, than going long. And it's funny you asked me this, or Marty's asking me this, because an investor asked me the same question yesterday. How is the Ukraine going to affect oil and gold prices? They may go up fundamentally, but as far as how we're going to adjust our trading systems to accommodate for this, we're not going to do anything differently. We're going to keep everything as is. We're always working on improving quantitative research. This is why we essentially have a team, and we're looking to grow this team. But as far as performance, it doesn't affect us at all.
Yeah, I want to just sort of go back with you, because I thought it was an interesting conversation I was having with Mike about, his risk mitigation strategies, and particularly, he does directional. You obviously are try to take advantage of trends and things of that nature as they're happening in real time. So talk to me a little bit about your risk mitigation. I know you mentioned the stop loss as well, but why don't you fill in around that and put a little more color to it?
Yeah, so there are all sorts of types of risk, right? There are operational risks, trade risk, broker risk, team risk. And so we try to address them to the best of our abilities. And for the most part, I agree with almost everything that Mike said. I just want to perhaps elaborate on a few things that we do. There's cross-asset diversification, which I previously just briefly mentioned earlier. It doesn't serve us a purpose if we have a position in both U.S. oil and UK oil, right? Brent versus WTI. And it makes that to us is improper asset diversification. It wouldn't make sense for us to trade both the Nasdaq index and the S&P 500, right? That's not proper diversification, because if we're wrong, then we're not trading properly, right? So this is a form of asset diversification that we take in consideration. So we can trade. So correlation is a big important factor for us. If we're inversely correlated, that's fine. If we're direct correlated, then that seems a little bit like too much risk for us. So we don't like to do that.
I guess one of the risks, and it's hard to quantify this risk, is the changing speed of the world seems to be getting faster and faster with change. You seem to be set up in a way to take advantage of those changes, perhaps quicker than some other strategies. So
Absolutely.
Missed opportunity risk, I guess, is what maybe it comes under, or something along those lines. Talk to me about how you try to take advantage of that, and how that's worked for you, and how you control it as well.
So believe it or not, most quant firms or quant hedge fund managers, they want to create a strategy and backtest it 5 years out and see how it does. Things were different 5 years out. Trading volume was different 5 years out. The volatility was different 5 years out. So they're trying to test something static in context of something that was dynamic every single day, right? So instead, what we do is we test only the previous day's data, which seems crazy, but it works. Because what we're doing is we're testing, let's say we're backtesting a strategy. We're going to test how the dynamic strategy performed on Monday, and the dynamic version of that strategy, how it performed on Tuesday, the dynamic version of that, how it performed on Wednesday. So just to give you a very simple example, Someone's using the moving averages, which we don't use, by the way, but let's say someone's using moving averages to trade. So they're looking to use, let's say the 11 and 21 moving average or the 20 and 50 moving average. So they'll test that across all the previous days. To us, that's wrong. There's no optimization component in this. And so what we do is we optimize the moving averages for yesterday, if we're going to use them for today. And then the previous day, we're going to optimize them for the day before that, for that day. So, what we do is essentially called optimization, which again is very, very common overseas, extremely uncommon in the US. Someone using the RSI, they're always going to use the RSI 14. MACD, same parameters, 12, 26, 9. And to us, it doesn't make sense because you're expecting the data to be the same when the data is not going to be the same. So that's our perspective.
Terrific. Thank you for that. Michael, I want to hit you with this question, then we sort of have to wrap up. So I'm going to ask everybody after this that, with a parting thought or two, particularly why people should be interested in your fund and who you're interested in talking to, who might be in attendance here. But the question I want to put to you, Michael, and actually all of you do this, you're all involved in a global investment strategy. It's talk about the world today. Where are the opportunities in the world today? What are the areas that you're looking to, areas that you're avoiding, things along those lines? So, Michael, why don't you fill us in here on your worldview and how it impacts your investment strategy?
Yeah, so building a bit on what Mina was saying earlier, our investment team, with the way our platform is set up, the way the risk is managed, and with the way the traders are onboarded, we typically our typical holding period in our investment horizon is measured in minutes, hours, and days as opposed to weeks and months. So as a general rule, we stay away from the longer term investment strategies. We stay away from things that we can't really put our arms around and monetize over the course of a week or two of trading. Our belief is twofold. Number one, as interest rates go up, volatility across the different asset classes in the markets goes up. Number one, that's going to result in assets being better, quote unquote, better priced, meaning that risk is going to be more properly priced than it has over the course of the last 10 or 12 years. And volatility is going to go up as well as this transition from the old regime to the new regime comes in. And I'd like to think that we're in a good position to capitalize on that repricing of risk and as well as that increased volatility across asset classes.
And do you want to talk just a little bit about how you see the global world?
I don't think I could offer anything as meaningfully different than anything that was expressed in the previous discussion.
Okay, fair enough. Well, then
can you get your guys as one final question to also discuss the impact of liquid alts, and whether they do separately managed accounts and any kind of intrusiveness of fintech or AI into what they do?
No, we're not going to do that, Marty. I'm just kidding. All right, let's see. We'll pick up with Mina. Why don't you be the starter on that question?
The landscape or AI? What are your thoughts?
On
Marty's question about the
Is there any intrusiveness into what you do, or is it an additive or negative that AI, emergence of AI and other things like that into trading strategies? AI,
yeah,
liquid alts, things of that nature.
Yeah, so I think that's the future. And right now we don't use AI per se, but that's one of our long-term goals is to basically, instead of manually optimizing every single day, our goal is to automate the optimization process, which would require some type of AI or machine learning model. As far as other future innovations, I think Michael's model is going to take over. Ultimately in the US, 5 to 10 year span, it's already slowly starting to expand as far as how to onboard new emerging managers. So rather than simply waiting for a 2-year track record, you simply provide an emerging manager with a demo account. You analyze them anywhere between a month to 3 months, and if you do well, you satisfy their risk management parameters, then you fund these guys. So I think a lot of things are going to change in the U.S., but it's going to take some time. Of course, that is in part because of technology and adapting more. So
Terrific. Anybody else? Michael or Mike, do you have any thoughts on the subject?
We do have some managed. Yeah,
Oh,
go ahead, Mike. I'm sorry. I was going to just say, we do have some managers that are using AI. I think it's in its early stages. Fintech. Again, we're heavily involved in the crypto space. In terms of, we don't do any UCITS and we don't do SMA simply because as a platform, it's almost impossible to figure out how to allocate capital and returns. So we don't do any of that. You either invest in the main fund or not.
Terrific. And Mike, you want to just throw in your last 2 cents, and I'll ask everybody to wrap up with a final thought, and particularly, who should be, who should be interested in you and why, basically.
Yeah. So just to cover Marty's question, I will say that, K2 Advisors, where I was previously, they were actually specialists, and they tried to create an entire platform around the liquid alt space. And by and large, almost every single liquid alt product was a drastic underperformer to the flagship traditional fund. And a lot of that just boils down to liquidity. You can't put on the same position sizes because if you have to meet daily liquidity, it creates a lot of headaches. So I think that's a very challenging space. When I was there was a struggle to really grow that. I know a lot of larger firms are trying to put out UCITS and 40 Act funds, but I think that's a difficult venture. AI trend, I actually tend to go, in the opposite direction. I know I referenced a lot of the old school discretionary macro traders. And, for me, our holding period is anywhere from a week to a couple of months, kind of relying on that idea behind academic studies where momentum tends to be strongest around that 6-month time frame. So we're trying to get in early on the moves, and catch that surge, a shift in sentiment, and use those, windows. I will say I'm not an economist. I'm not trying to predict the world. I try to consume all the different views and then observe market behavior and a lot of the different indicators that I've built to sort of inform me of, okay, this economist view or this point, or, these things are making sense and the market is starting to behave that way. And how does that relate to market positioning? So it's kind of a back to the old model, where a lot of the old macro traders have retired and closed down. It's sort of reviving that mentality, and that's why I think with Joseph's comments about, where the world is, I think there's so many unprecedented situations, and whether it's policy or rates or inflation, supply chains, it's going to favor the active and the very nimble players, where your traditional 60-40, or even throw in some real estate, that traditional asset allocation is not going to serve you well, especially if you have certain return targets over the next decade or so. And I think that's the biggest point for, as again, trying to identify those right partners in the ultra high net worth and family offices for the launch of our fund. And again, that's the main reason, right? Is the ability to be nimble, the smaller size, to capitalize on a lot of this volatility, because as inflation and rates are higher, by extension, volatility should remain elevated, as we've seen for the past, 2 or so years. So.
Fantastic. Thank you. Mina, you want to follow up and just sort of give your closing statement here?
Yeah, well, first and foremost, thank you guys for inviting me to be here. Happy to be here. We're always looking for innovative partners who value and see what we do. If there's a bad partnership, then obviously that's detrimental for everyone and in a negative way. So it's important that, both investors and the hedge fund manager are on the same page. And so we're looking for like-minded entities, family offices, hedge fund managers, funds of funds, anyone really who values what we do. As far as why, to us, it's pretty obvious. We prioritize risk management, whether it's stop losses, volatility, trade operations, asset allocation. We've essentially dissected it almost to a science at this point, and it's systematic. So our goal is to preserve wealth and not wait, a 1 to 2 year lockup period before an investor can recoup their return on investment. So that's why we created this fixed income product. We're trying to do things differently, things that I've learned from overseas, things that I'm trying to bring into the US. And so, we hope it's appealing to investors. And obviously, if anyone has any questions, they're more than welcome to reach out to me.
Fantastic. Michael, you get the final word here.
Well, thanks. Again, echoing Mina's comments, thanks, Mark and Marty, for the invitation. So look, probably the easiest way for me to describe it would be to describe the profile of an investor who I think would be very frustrated with. So first, if you're an efficient market person, where you think that all markets are efficient, you're going to be very frustrated, because a lot of what we do is mine opportunities where the markets are not efficient. A great example of that is one of my favorite strategies that we just onboarded. It's a team in Taiwan who arbs between the COMEX gold contracts and the gold contracts that are being traded in Taiwan, principally by local retail investors. And we own that. And the reason we do that is because those markets are not efficient. The second guy is the guy who thinks that markets are mean reverting. I've had so many people come to me and say, well, gee, if you're up 20% in 1 month, that means you can be down 20% in a month. And the way we manage risk is simply that, and I would never say never, but, the probability and the likelihood of that is extremely low. So if you're looking for niche, specialized managers, we're the place for you to allocate to.
Oh, my microphone's down. There we go. Well, thank you, Michael. Greatly appreciate that. And thank you, everybody in the audience, for your time today. We heard from 3 really terrific emerging managers offering active and nimble strategies for achieving the returns in an uneven, changing world here. So I think there's 3 great reasons to be talking to them. I'd ask Michael and Mike and Mina to please, in the chat room, type in your contact information, let people know how to reach you. I want to touch on the point that tomorrow I'm doing a panel on alternative strategies. And during that, we will actually be discussing a lot the AI impact with Olga Kane. So that'll be an exciting topic that people may want to tune in for or be present for during tomorrow.